Hello, good morning, good afternoon, and good evening to everyone. My name is Maria Jose Romero, and I work for Eurodad, the European Network on Debt and Development. Welcome to today's session. It's the second session of the Skilling Up on Climate Finance webinar series. And today we will be discussing how transparent and accessible climate finance is. We will listen from distinguished guest. But before that, I would like to share with you some brief housekeeping rules that will allow us to have a very interactive, hopefully, and engaging webinar series. Today's webinar will last 1 hour and a half. The first part of the session will be recorded. The recording will stop just before the question and answer session after about 45 minutes. The session is available in English, French, and Spanish. You can select your language in the interpretation menu at the beginning. You can ask written questions throughout the web at the bottom of your screen, Zoom. You can also upvote questions that are already asked. The written questions cannot be translated. You can also take the floor to ask your question in the second part of the webinar. In order to do so, just raise your hand via the button at the bottom of your screen and turn on your video if you wish, and you will be given the floor. If you will ask your question in French or Spanish, make sure to turn off your own interpretation via the button off in the interpretation menu at the bottom of your screen. You will ask for a final question at the end of the webinar through Slido. The link will be shared in, and the QR code will be shown on your screen. The presenters, our speakers, will share their PowerPoint presentations during the session, and they will be available via email after today's webinar. To kick off the session, we will launch a poll to get a bit of the sense of the room in relation to the main thing that we will be discussing today. So the question for you to share with us your answer is, how is the majority of climate finance provided? You will have to answer with just one of the options, and the options are loans, grants, or, well, a split between loans and grants. So now you have the question on your screen in Zoom. Please share with us your answer, and we will see what's the sense of the room. Okay, fantastic. I now get the result, and a great majority, more than 80%, answer that it's through loans, which is the right answer. So now we will hear from our speakers. Each of the speakers will have about 12 minutes to share their views on the issue that we will be discussing today. The first speaker sharing with us her views is Carola Mejía. She is climate finance analyst working at Latindadd, which is the Latin American network on economic and social rights. But please, Carola, you will have also the chance to talk briefly a couple of words about Latindadd. The topic that Carola is going to share with us, it's in relation to the most common climate finance delivery mechanisms that are used by the largest climate finance providers. And it's also worth introducing Carola, because she's a Bolivian economist with over 13 years of experience as an advisor and consultant for public, private, and international cooperation institutions on environmental projects, climate finance, and sustainable development in Bolivia and across Latin America. And it's a pleasure to have Carola with us today. A great pleasure. So Carola, you have the floor now. Thank you.
Thank you very much, Maria Jose, and thanks to Eurodad for the invitation. It's an honor to be here with all of you. Good afternoon, good evening, and good morning to everybody that is joining this webinar. As Maria Jose was mentioning, I work for Latindadd. It's a Latin American network focusing on social and economic justice, but for 2 years, it also has been working in climate justice and focusing a lot on climate finance, which is what I'm going to share with you today. I'm going to share my screen. Please tell me when you can see it. Okay, and I will be presenting the most common climate finance delivery mechanisms, especially provided by public climate finance providers. But I know you may be aware of what is happening about this climate crisis. It is a global crisis that needs to be tackled with a joint effort from all countries, and that's why the United Nations Framework Convention on Climate Change is working, and a very important agreement was the Paris Agreement signed by 195 countries in 2015. And they set 3 main goals: limit the temperature increase 2 degrees, or if possible 1.5 degrees, which has been the goal also confirming after the COP26 in Glasgow. Also to strengthen the adaptation capabilities, and also to mobilize climate finance from developed countries to poor and developing countries. This third goal is very related to the principle of common but differentiated responsibilities. We all know that global North countries have a historical responsibility on the climate crisis that we're suffering now, and we know that southern countries are the most affected and vulnerable to climate change. So recognizing that the differentiated responsibilities, global North countries have set this goal of mobilizing 100 billion per year from 2020 to help less developed countries tackle climate change as well. But unfortunately, the 100 billion target has not been met yet. They say they were going to achieve it in 2023. Unfortunately, climate-related needs are estimated to reach trillions and not only billions, unfortunately. And a new climate finance goal is being discussed as part of the climate negotiations. They are trying to increase this goal, but we are very concerned because the previous goal has not been met yet. So there's a lot to do regarding that. I know in the first session you heard what is climate finance. There is no like one definition, but this is the finance that goes to measures related to mitigation and adaptation. Mitigation is the reduction of greenhouse gas emissions or absorption of these emissions, and adaptation is to increase resilience and to be able to be prepared to receive these climate impacts that we are already suffering. This is supposed to be additional to ODA and to other pledges related to development finance. This is supposed to be specific for mitigation and adaptation. Unfortunately, there is no facility yet ready to cover loss and damages that vulnerable countries are receiving right now. They are relying on debt and on their own resources to fight these extreme climate events. And the way that climate finance is delivered, climate finance could come from international, national, public, and private institutions. It can come in form of grants, loans, equities, concessional loans, technical assistance, insurance payments for results, subsidies, carbon markets, or green bonds. there are different instruments and mechanisms used right now. And I'm going to explain a little bit more in this scheme that I prepared. This is the global finance architecture. You can see in the top, these are the countries that are the most important providers: Australia, Canada, the European Union countries, France, Spain, UK, Germany, Japan, Norway, US, and Denmark. They are the contributors that help recipients, which are mostly poor and developing countries. They deliver these climate finance resources through bilateral institutions. For example, these are some examples: USAID, AFD, JICA, the Japanese Corporation, the German Corporation, or through multilateral institutions. In the multilateral institutions, we have different mechanisms. For example, we have the UNFCCC financial mechanisms that have been created. For example, the carbon markets created under the Kyoto Protocol that now are going to be changed or adjust according to the new negotiations, but they are going to still be an important mechanism. And we have also the non-market mechanisms, which are mainly big climate funds, as the Green Climate Fund, the Adaptation Fund, the Global Environmental Facility, that are also very important for helping developing countries. There are also the non-UNFCCC financial mechanisms, many of them related to UN agencies, for example, UNDP, the UNEP, FAO, and we also have the multilateral development banks, which are also very important, and you will see with the data, they are very important in delivering this climate finance to poor and developing countries. We can see some examples: the World Bank, the IDB, the Asian Development Bank, the African Development Bank, the European Bank, the European Investment Bank. And we also have regional and national accredited implementing entities, and we have also regional and national funds. This is an example in Brazil, the Fundo Amazonia. It's a very important and local national fund that receives a lot of climate finance from international, national, private, and public sources to be then delivered to projects related to the conservation of the Amazon. So that's an example I wanted to give to show that there is a very different, there are a lot of institutions from different sites related to this. And we also have the private finance that is going to be parallel to all of this. But many of these, for example, multilateral development banks also help climate finance, private climate finance come to the table for some projects. I'm going to give some data related to the climate finance mobilization in 2019. This is the data from the OECD. The average annual flow reached 79.6 billion. We can see we are below the 100 billion annually. From that amount, less developed countries received 19%. Small developing states, the small island developing states, which are the most vulnerable to climate change, received just 2% of that amount. And we can see in the map the distribution among regions. Asia received 43% of that, Africa 26%, America 17%, Oceania just 1%, Europe 4%. In the other graphics, we can see how this climate finance is being distributed among projects or the impact of the projects. And we can see that mitigation is receiving 64% of the total amount, which is something that is very, it's very negative in relation to the needs that vulnerable countries have to adapt to climate change. They are only receiving 25% of this amount of money. And it has been recognized as a problem in COP26 in Glasgow. Countries have committed to double this finance for adaptation and try to balance this. Related to the source of climate finance, we can see that multilateral public finance is 43%, bilateral public is 36%. So in total, public climate finance is 79%. It's very important. Private mobilized by these mechanisms is 18%, and export credits related to climate change is 3%. If we see in more detail the public climate finance per instrument, we can see here, and excluding export credits, we can see here in 2019 that loans represented 71% of public climate finance, which is something that we are very concerned of, because using loans as the main mechanism increased debt levels in vulnerable countries that already have to face super high levels of indebtedness. So that is something that we are very concerned of. Grants were only 27% related to public finance. And the implications of climate finance in these debt levels, it's something that we are working a lot, as well as as Eurodad, APMDD, AFRODAD, and other big allies we have. We are very concerned because, as Eurodad shows always, there is like a vicious circle between these two problems, the climate crisis and debt. Higher debt levels implies less fiscal space to finance climate change mitigation and adaptation measures in vulnerable countries, less chances to obtain any funding to recover after disasters, less possibilities of financing other needs, rights, and services. Usually, when you prioritize the pay of the debt, you reduce your expenditures in social protection, for example, and there women, children are the most affected. Then you have also more pressures for developed countries to overexploit natural resources and promote destructive and high contaminant, high polluting activities. For example, hydrocarbons mining, as my country, for example, Bolivia, relies a lot in the export of gas. So we are doing a lot of investments in the hydrocarbon sector, and we are not going to, it's very difficult for us to change this, to pay the debt service and to guarantee growth and development that is never coming to us. And for in the other side, greater climate vulnerabilities implies high borrowing costs, and that's something very unfair. Countries that are most vulnerable to climate change usually pay more interest rates because of the risk associated to this climate extreme events that could happen and can affect the payment of debt. That also affects results in greater macroeconomic volatility, higher risk of debt and sustainability, lower long-term growth prospects. And we believe it's very unfair that global south countries are unfairly paying for the climate debt of the north, even with higher interest rates. And we're part of this campaign, No Climate Justice Without Debt Justice, that we invite all of you to join if you're not ready already. And we have also these very important climate funds. Green Climate Funds is the Green Climate Fund, the GCF, is one of the examples. It offers grants, concessional loans, guarantees, equities for climate change mitigation and adaptation projects. It aims to have a balanced portfolio between mitigation and adaptation. It also offers readiness support for countries. The funds are channeled through accredited national and international entities. For example, multilateral development banks can be accredited entities that help deliver these funds through them. Each country has a focal point. They offer micro, small, medium, and large the finance for micro, small, medium, and large projects. The micro goes from 0 to 10 million, the small to 10 to 50 million, and the other one 50 to 250 million, the medium, and the large size scale projects are for more than 250 million, which is very interesting. But the bad thing is that these kind of funds are very inefficient. They are very bureaucratic. They use a lot of time from the presentation of the proposal to the approval of this. And as of 31st of March 2022, $10.2 billion were approved for 192 projects in 128 developing countries, out of which 2.54 billion has been disbursed. There's a low rate of disbursement. And from this total amount, 44% is for mitigation, 24% for adaptation, and 32% for cross-cutting. So there is no balance yet. And we also saw that the GCF portfolio, as we can see in the graphic below, has been using loans as the main mechanism. 44% of the funds, climate finance that has been channeled through the GCF is going through loans, 42% through grants. It is true that these are more concessional loans, but still they are loans, and this is the mechanism that we are criticizing a lot. And yes.
Sorry, Carola, you have just one minute. Thank you.
Okay, thank you. Okay, this climate finance is mainly centralized through national governments. And the problems related to access is that the developing countries have very little knowledge about climate finance available sources and instruments. And the format and the processes are long and difficult. There is a lack of technical capabilities to prepare bankable proposals, low borrowing capacity for poor and middle-income countries, weak coordination mechanisms, lack of specific climate finance-related policies in developing countries, and also, as final remarks and to wrap up this conversation, we believe that within the framework of the global financial architecture, the use of non-debt creating instruments should be promoted in favor of developing and less developed countries. Loans should not be the main instrument to deliver effective and fair climate finance to the global south, especially considering this principle of common but differentiated responsibilities. Developed countries must meet the goal of mobilizing 100 billion annually, which in fact must be higher given the financial needs. Within the framework of the climate change negotiations, progress must be made mobilizing resources to cover loss and damages derived from climate change. We have been asking and demanding a financial facility to cover also for this. More resources must be mobilized for adaptation. The demand has to be doubled. Financing must guarantee that projects include gender and ethnic approach, both in the design and implementation stage. It is not only about quantity, the quality is very important as well. And more efforts should be made to decarbonize economies and reduce national and international finance for extractive activities. Climate finance is very important, but it's not going to work if they are still investing in fossil fuel industries and sectors all over the world. So we have only 8 years to tackle climate change. We are very late, and we have to act now with more ambitious related to the goals that the countries, especially most developed countries, have set. And climate finance should come, but in a fair way, and to secure that is going to be very effective for developing countries to tackle climate change as well. Thank you very much. And these are just two documents that you're going to find that have been very useful for Latin America, because they have a lot of information regarding climate funds and how to access them, what are the instruments they offer, which sectors, and everything. So thank you very much.
Thank you to you, Carola. It has been great to hear all the things that you share, in particular in relation to the implications of having loans as the main financing instrument through which climate finance is being disbursed. And also the very timely references to the issue of debt and the campaign that we are all working on, which is no climate justice without debt justice. So I am really looking forward to the question and answer session, when we will have the chance to hear even more from you, I am sure. So now I would like to turn to our second very distinguished guest. She's Berta Argeta, Senior Advisor on Climate Finance and Development, working at Germanwatch. Berta is going to talk to us about access to climate finance and key issues emerging, including transparency issues, accounting and reporting, and also the issue of commitment versus disbursement, which, as we heard from Carola, it's something that it's also very important to reflect on. Berta is, as I said, a senior advisor on climate finance and development at Germanwatch. She's an economist and the co-author of the 2021 Climate Finance Advisory Service report titled Access to Climate Finance for the Most vulnerable. And again, it's a pleasure to have Berta with us today. So the floor is yours. Thanks.
Thank you so much. I hope you can all hear me. I will share my presentation now. Hope it's the right one as well. I will be introducing a little bit, move past this, the issue of access to finance. The first two parts on defining access and the status quo of access are based on the paper that Maria Jose just mentioned, that was published by our consortium, the Climate Finance Advisory Service, last year before the COP26. And then the last part will focus on emerging issues, mostly focusing on what came. This is not necessarily new issues, but more like issues that have come up with more strength after COP26 and will be relevant leading up to the next COP in Egypt at the end of this year. So basically, as I said, this comes mostly from our paper. We were trying, first of all, when we were thinking about these issues about how to define access. It's quite a complex question. We discover many aspects to it. The basis is basically that if you listen to the conversations internationally, many developing countries have increasingly stated that the resources that have been supposedly made available by mostly developed countries, as indicated in the reporting of what they have provided as climate finance in the past years, has not been reaching these countries. You know, there's all this money that is supposed to be available, and everyone's kind of wondering where it is. And this is a discussion that has been part of the processes and initiatives of the UNFCCC for a long time, going back to what I was mentioned before about the 100 billion goal. And it has been linked obviously to issues of accessibility, of how to access or how much access do countries have to these resources. And more recently, it's been included in the discussions that were launched last year on the new collective quantified goal, which is the goal that the climate finance goal that it's under discussion right now, and it's going to be the new goal post 2025 when the 100 billion goal basically runs out, to put it that way. So when we were thinking about this, and this was also based on a roundtable we had with developing countries for this paper, we kind of identify different elements to this question of access. One of them is obviously what we call the content, which is basically just the money being available. I mean, obviously you cannot have access to something that doesn't exist. So the level of funding provided is important to the issue of access, in the sense of it has to be sufficient to meet the needs and priorities of developing countries, in this case, the most vulnerable, because that was the focus of the paper, but in general of developing countries. So if the level of funding available is not enough to cover these needs, then obviously we have an issue of access. And this needs-based finance is a question that has come up and will be coming up for a long time in the discussions on the new collective quantified goal. But also, like, the instruments that are being used, are the instruments be appropriate? Because obviously, and I think this is something that our previous speaker spoke to as well, if the instruments are not appropriate, if there's loans or the instruments are hard for some to access, that will also create an issue of access. And then we have the format, not the availability of money, but what formats developed countries and the institutions through which they provide funding use to make this funding available. So what formats do they use? And in here, we saw that there's quite a big divide. It is not necessarily a contradiction, but a divide in views between an emphasis on the capabilities of developing countries to access finance. And I think we also heard a little bit about whether they're capable of preparing funding proposals and making these proposals bankable, whether they have the ability to set priorities in their planning processes and budgeting processes, whether they meet the fiduciary standards of certain institutions to access funding, if they have the necessary safeguards, etc. So obviously that's an issue of capacity of developing countries. You know, all of these capacities are necessary as the architecture stands for them to be able to access funding. And if they don't have these capacities, then they cannot access the funding. That's one of the views. On the other hand, we have a different, let's say, issue or like group of issues of format, which do not relate so much to the developing countries themselves, but to the institutions that are providing this funding. And in this case, for example, if you remember the picture of the architecture of climate finance that Carola was showing, you will remember that there's a wide diversity and complexity of funding institutions. And all of these have their own requirements, their own criteria, and it's very hard to like, you know, keep up with all of these different requirements and criteria. So that's one. Some of the requirements are obviously made, not necessarily on purpose, but unfortunately that's why it is, to favor intermediaries instead of direct access, meaning that they're made so that big organizations like the UN agencies and the multilateral development banks have easier access to this funding that, let's say, national banks or other national institutions in developing countries. So there's no direct access so much as there is international access through these intermediaries. And there's also a lot of what we could term exclusionary eligibility criteria, basically, you know, levels of income, as if that had anything to do with the vulnerability to climate change. So the higher income levels sometimes make you less eligible to access certain types of financing, especially grants. And this is particularly an issue for small island developing states, which are highly vulnerable to climate change, but at the same time, some of them have high incomes or higher incomes. And so they sometimes get like, you know, bumped out of the more concessional finance. We have also the transparency of the processes. Many of these funds make decisions about who they give money to without any transparency as to how these decisions are really being made, and the flexibility to account for specific local context. So sometimes the requirements are so stringent that they cannot allow for specificity of local context. And so underlying all of these, we also have, you know, the basically flexibility, issues of accountability of how this funding is being provided and to whom. And this is not accountability only from the point of view of those providing the finance, but how accountable we are being to the communities we're supposed to be serving about how this money is being used. So the status quo, I won't go through the more quantitative part too much because we've already seen the figures shown by Carola, but basically climate finance flows fall short of the needs of developing countries. That is very clear. There's an inappropriate balance of instruments and thematic focus, as Carola already mentioned, more instruments, more debt creating instruments, and more focused on mitigation. And there is insufficient access to international climate finance, especially for the most vulnerable. It tends to cluster around bigger countries with higher incomes and not necessarily reach the smaller countries or the countries with lower incomes. However, we also look at the status quo in terms of more qualitative aspects. And in here, if you remember, like the architecture is quite complex. So you have bilateral funds, multilateral funds, and then you have the specific multilateral funds of the UNFCCC, like the GCF, the Adaptation Fund, etc. So these issues of access are not equally distributed, to say like that, between all of these. Some of them are specific to some types of channels. So for example, when we see a bilateral funds, the thing with the bilateral funds is they're usually discretionary in nature. Each country, when they go their own bilateral organizations, decide which regions they're going to focus on, which topics they're going to focus on, and then, you know, basically to the exclusion of everything else. They're also prone to be serving more the donor countries' interests and goals than the needs of developing countries. And there's a very scarce devolution of decision-making, meaning the true decisions are being made at the donor level and not at the, I don't want to say recipient, but developing country level. And so therefore they used to concentrate on selected countries. And so it's the fair access to all is quite challenging. Then we have issues more of multilateral sources like the multilateral development banks, in which, as I said, eligibility criteria like income classification makes it hard for some higher income countries, which are highly vulnerable, to access certain types of finance. And this leads to the fact that, well, if there's the only thing on offer is low concessionality or no concessionality funding, some countries that have high levels of debt might not be able to access these because they are already so indebted that they can't take on more debt to finance adaptation and mitigation priorities. And then in terms of the financial mechanisms of the UNFCCC, like the Green Climate Fund, Adaptation Fund, etc., they do have specific mandates for example, adaptation or focus on the most vulnerable. And they have worked, let's say, towards more capacity building, more simplification, more country ownership, but there's still many gaps, many gaps in how really devolved the decision-making is, how simplified the processes are. If you follow a little bit the Green Climate Fund, there's a big discussion just this week actually about simplifying the processes even further because the simplification has not worked. So just to give there's many other issues, but just to give so what are the emerging issues based on this status quo as I've presented it? This is the discussions on the post-2025 goal, the new collective quantum just starting. We only have had one technical session on this and a few submissions on what different countries think are important issues to tackle. So I have tried to make a really quick summary of where this is going because it's still going in many directions. But basically what we could look forward to in these discussions is in terms of qualitative aspects, there's a push for simplification and harmonizations of procedures from all of these different funds, to try to kind of simplify and harmonize this so that it's not so hard for developing countries to understand the different criteria. There's also a need to tackle the eligibility issues I was mentioning about income levels and many other eligibility issues that, restrict access. There's also a push for more direct access modalities, so less dependence on the intermediaries at the international level and more funding going directly to the national level, and especially for some people, like civil society, the local level, ideally. Links to increasing debt levels and therefore the push for more grant-based finance, especially for adaptation, where it makes more sense. I mean, it's not that it doesn't make sense in mitigation, but adaptation is a particular difficult topic to tackle with other things than grant-based finance. And the support for enhancing the capacities to access finance. So there's still need for capacity in the developing countries, but it's not only an issue of capacity, there's also many other issues of access. And then from the more quantitative perspective, obviously we're talking now about needs-based goal, not the 100 billion as it was established, which was more of a political commitment that came out of nowhere, really, but more on a new goal based on the real assessment of the needs and priorities of developing countries. For this, the discussion is which estimates of needs do we use, top down, bottom up, who decides, etc. We already have some work from the Standing Committee on Finance on needs, but obviously there's still much to be done to plug certain gaps, especially for adaptation. And then there's the issue of transparency, which I think you mentioned. Why? Because at the end of the day, we cannot really know what the goal is and how it's being met if we don't understand very clearly what we understand by climate finance and have strong accountability and reporting of whether these finance commitments are being made. So there's a lot of talk about how this enhanced transparency framework that came out of Paris for reporting is going to be used to build accountability for the new goal so that we can assess how this new goal is actually being met and track the funding. And this is linked to another discussion that's being had at the Standing Committee on Finance, which is what is the definition of climate finance? Because if we don't have a unified definition, everyone says whatever they want, and we end up with all sorts of activities being considered climate finance when maybe they shouldn't be. And so there is a link to these discussions on the definition of climate finance. And then once we understand that more clearly, how do we account and report what's being provided and to whom in a very transparent way. So I don't have an answer to that, but obviously it's going to be a very important topic that it's emerging, about how the accounting for this is going to be done. To make sure that, as I said at the beginning, the things that developed countries are saying they're providing actually match what developing countries are actually receiving. So that's basically it. So thank you very much for your attention. And back to you, Maria Jose.
Thank you. Thank you very much, Berta, for sharing all these very insightful comments and points with us. It was very important to hear from you right from the beginning, the main elements that define access to climate finance, and towards the end, some of the highlights of conversations that are now emerging on the new collective goal that will be with us post 2025. So it's very important for us to continue this conversation. And to do that, before giving the floor to our third speaker, I would like to remind you all that you can ask written questions now and throughout the whole webinar via the question and answer function at the bottom of your screen. You can also upvote questions that are already asked. There are two very interesting questions in the Q&A function already, and we would like to encourage you to raise and ask even more questions. We will have the chance to discuss all of them later on. So now I will turn the floor to our third very distinguished speaker. He is Adrian Chikowore from the African Forum and Network on Debt and Development, AFRODAD. He will be speaking about private finance, climate finance flows, and their sustainable development implications. Adrian is the policy and research consultant in international public finance thematic area portfolio at AFRODAD, and has a wealth of experience working on economic justice and debt-related issues. I would like to give the floor to Adrian. It's a pleasure to have you with us today. The floor is yours. Adrian, can you hear me? I am aware that he is having some technical problems. That's why his video has been off also when we tested that. But are you with us, Adrian? Hello. Sometimes these things happen when
Hi, MJ. I don't think that Adrian is on the call anymore. I think that his connection has perhaps timed out. So perhaps we could use this opportunity to take a few of the questions that are already in the chat function. So just to introduce myself, my name is Leah Achampong. I work on climate finance here at Eurodad. So in terms of the questions that we have here, I can see that we have a few, and thank you to all of the panelists who have already spoken up. I'll start with some of the written questions. I can see,
Leia?
Yes?
Leia, I am really sorry. The point is about the recording, because the agreement at the start of the webinar is that we could be recording up to the point of having an exchange with panelists. So I think that we can stop the recording now, and we can continue with the question and answer session. And if Adrian joins us, we resume the recording. I guess that this is fine with you, and of course you have the floor now. Thanks.
Yes, perfect. Thanks, MJ, Maria Jose. So in terms of the questions that we have now, we have one on